what about gold and silver? What are they doing? Well, gold is broken through 3,900 quite easily. We're at 39.33. The high's been 39.45, so we're up about 47 bucks. Silver is up about 60 cents at 48.56.
Gold will just continue going north and get more and more and more overbought, and it has nothing to do with the situation. It does not matter. Here is the entire bull market of the 70s.
Mike Maloney, a longtime advocate for precious metals, continues to warn that the global monetary system is entering its most dangerous phase yet. His analysis of gold centers on the growing instability of fiat currencies, ballooning debt levels, and central banks' desperate attempts to control inflation through artificial means. Maloney emphasizes that gold's recent price surges are not merely speculative moves, but structural signals that confidence in paper money is eroding at an accelerating pace. He argues that while short-term pullbacks are inevitable, the long-term trajectory for gold is set by fundamental forces, namely the collapse of trust in fiat and the inevitable revaluation of real assets. According to Maloney, we are witnessing the early stages of a global repricing event that could redefine gold's true monetary value. In his broader outlook, Maloney often draws parallels between today's financial landscape and historical collapses of fiat systems. He points out that every major currency in history has eventually failed, and that gold has always emerged as the ultimate store of value when paper promises burn out. The difference now, he explains, is the scale. Trillions of dollars in unbacked debt and derivatives hanging over the global system make this collapse potentially unprecedented. As central banks quietly accumulate gold while offloading U.S. treasuries, in his view, this silent migration toward tangible assets is the most underreported trend of our time. Looking ahead, Maloney foresees a period where gold could break free from the constraints of manipulated markets and suppressed pricing mechanisms. He believes that once confidence in the dollar fully unravels, gold will not only surge in nominal value, but reclaim its status as the backbone of global trade and settlement. The endgame, as he sees it, is a monetary system partially or fully relinked to gold, whether by design or by necessity. Maloney warns that this transition will be chaotic, but for those who have positioned themselves early, it could mark one of the greatest wealth transfers in modern history. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is broken through 3,900 quite easily. We're at 39.33. The high's been 39.45, so we're up about 47 bucks. Silver is up about 60 cents at 48.56. The high's been 48.67, and as I said, it's 8 a.m. London time right now. The rest of the markets, the Dow futures up 100. The NASDAQ 100 is up 111, and the S&P is up 20. So, yes, this is very important. This new Prime Minister of Japan, Takaichi, I think is her name, she's going to inflate things even more. And so let's go back to tokenization. And I said earlier that I've looked at the definition of inflation back in the 70s before they changed it, right? Because they don't really want the public to know what inflation is. The public thinks that CPI is inflation. CPI is just a phony government measure of prices. So let's go to page 365 in this dictionary under inflation. It says, an abnormal increase in the volume of money and credit resulting in a substantial and continuing rise in the general price level. So nowadays, they don't tell you that the price rises come from inflation, right? They tell you that the price rises are the inflation. And why do they do that? Well, because they need to make sure that you don't know that it's actually government and the central bank that create the inflation. It's not Putin, it's not house prices or grocery prices that cause inflation, right? It's the government and the central bank. So, yeah, why am I talking about inflation if we're going to look at tokenization? Well, because I think it's really important to look at the definition of words. And you probably heard the saying, it's a token of my appreciation. It's not something huge, right? Someone's done something for you and you just give them something, as a token of your appreciation. So hopefully, that will open your eyes. But let's see what they say here about token. An outward sign, symbol, emblem. So it's not the real thing, it's a symbol. A small part representing the whole. Well, there you go, a small part. Token, there's another definition here. The adjective of token, done or given as a token, especially in partial fulfillment of an obligation, minimal, perfunctory. So you get the idea. So I've seen recently the market sniper talk about the topic, and I think I'm going to have to get him on to speak about this. He posted this on October 3rd. Friday. He said, the sales pitch for tokenization is this amazing fractalized ownership for all items where equity and everything is available to all. In evil, greedy, and likely Marxist hands, tokenization is not your friend. It is a tool of dispossession. I agree 100% with him, and that's why I think it's a backdoor to the great taking. And I think an upload of a remote derivative purchase of your assets into a rentier society for the masses. So yeah, what they're going to do, for example, I'll give a company my gold, my sovereign here. They'll take it. They'll give me a token for it. They'll lend it out. They'll make most of the profit, give me a little bit, and I'll probably never see this again as well. That's how it's going to work. And they want to do it with everything, real estate, other natural resources. And the people behind this, of course, are people like BlackRock and others, Wall Street institutions, right, that we can trust, not. So anyway, and the market sniper makes a good point here. He says, P.S. The bottom 90% of the U.S. population own 3% of the stock market. The top 1% are through 50%. Good luck if you sign us all up. So there you go. And he put a post here from Garrett Goggin. It says, tokenization leads to gold's return to the money system. The world's best store of value combined with frictionless crypto makes tokenized gold the ultimate medium of exchange. As I said, I don't trust tokenization. I wouldn't trust my gold with these people. The reason to have gold is that there's no counterparty risk. With tokenization, there will be huge counterparty risk. And that's why I think it's a bad idea. But if you want to risk your assets, if you don't have a problem giving control of your assets to Wall Street, go ahead and get involved in tokenization. So you can even see here that CNBC is pushing tokenization and crypto. It says, and this is an article from October 2nd, tokenization of real-world assets is an unstoppable freight train coming to major markets. Robinhood CEO. It says the tokenization of real-world assets from stocks to real estate will spread to financial markets around the world, according to Robinhood Markets Chief Executive Officer Vlad Tenev. Tokenization is like a freight train. It can't be stopped. Well, what do you mean it can't be stopped? And eventually it's going to eat the entire financial system. Doesn't sound very good, does it? And he says here that people will be able to own assets, real world assets all over the world through tokens. But can't we do that now already through owning mining companies and other things, or through owning privately real estate and some of this and some of that, right? So I think it's a really bad idea. as I said, it's a token. A token is not the whole thing. And I'd be very careful about it. I have actually a coin here from 1812. And back then, England was fighting the Napoleonic Wars, and there wasn't much silver around. And they had to use their imagination to get silver to circulate. And they issued a bank token, and it says here bank token 3 shillings 1812. It wasn't a real 3 shilling coin. Well, there isn't really a 3 shilling coin, but they had to say it was a token. As you can see here, a bank token. It's a token, right? So yeah, to sum up, tokenization is another Wall Street scam, in my opinion. It's going to make the bottom 90% even poorer than it is now, with only 3% of the stock market.
MarioInnecco, on the other hand, focuses on how gold's role is evolving through tokenization and digital finance. He argues that the next great transformation in the precious metals market won't be about price alone, but about access and integration into the digital economy. Tokenized gold, physical gold represented on blockchain networks, is, in his view, the bridge between traditional wealth preservation and the digital world. Innecco believes that as trust in fiat systems erodes, gold-backed digital assets will become the preferred medium of exchange, combining the stability of gold with the efficiency of blockchain technology. This shift could allow individuals and institutions alike to transact globally in a form of money that is both hard-backed and technologically adaptable. Innecco sees this evolution as part of a broader trend toward decentralization in finance. As CBDCs and digital surveillance currencies advance, tokenized gold offers a parallel system, one that preserves personal sovereignty and resists centralized control. He predicts that nations with strong gold reserves may soon issue their own blockchain-based gold tokens to stabilize trade, especially as the dollar-based system weakens. Such a development could mark a turning point where physical gold once again anchors global trust, but this time through digital infrastructure rather than physical delivery. For Innecco, tokenization represents not just innovation, but the rebirth of sound money principles in a digital form. Let's get back to the interview.
Gold is up 40% in 2025, its best year since 1979. But what I really want to point out here, this is 40.3%. And if you go across here, here's 37%, so very close to it. But then 1979, 1974, 73, 72, this first part of the bull market. Now, this was only Western Europe and Canada. It was still illegal to own gold or trade gold in the United States. This is this is some spectacular performance, but what this is saying is that the best is yet to come. We haven't even gotten started yet, folks. So James Anderson, my friend James, we worked together for many years. James started at goldsilver.com many, many years ago. 39% of fund managers surveyed are gold broke. That's 39, and it looks like it was about 41 or 42. It's 39, so these people that have no gold whatsoever, these fund managers, and I love this, money managers who don't know the first thing about money. They don't, because they're not buying money. They're invested in things that are everything's measured in currency to them. So 39%, 20% of them have 4% gold exposure, 16% of them 2%, 8% of them have 6%, and 6% of them have 8% or more. Only 6% have 8% or more. And I guarantee you there's going to be a day where all of them are going to have some exposure, and it's going to be at least 10%. Money managers, I don't know if they had these funds then, but brokers and so on, they didn't recommend gold back in the bull market of the 70s. It wasn't until after it was too late that they started recommending, put 20%, 25%, 30% into gold. And then that became less and less and less until it's, just 10%. And then it basically, by the year 2000, when gold was just $250 an ounce, they're saying don't put anything into gold because it's dangerous. You could lose. And because they want to sell you their products. And then you hear this fallacy of, just put 10% into gold because gold is so volatile, it's dangerous. Well, it's been the best performing asset of this century, other than cryptos, but when you start at zero, from 0 to 1 is an infinite return. So bar charts created this wonderful chart, and they were saying gold hit the most overbought level on the monthly chart in 45 years. Now, I tried to duplicate this chart, and notice it goes back to 79. I went back a little further, and I found something very interesting. If you go back further, first of all, it's not as overbought on the MACD that I was able to generate, and this is on a monthly, it's not quite as overbought, but it is in seriously overbought condition. But look at the first part of the bull market. Now, I'm going to zoom up on this a little bit more, the 70s bull market. So we are not yet as overbought as we were in 1980. So it would actually be good for gold to go sideways for a month and work off this overbought condition. But I'll tell you, none of this matters in a currency crisis. Gold will just continue going north and get more and more and more overbought, and it has nothing to do with the situation. It does not matter. Here is the entire bull market of the 70s, and this is only Western Europe and Canada driving the price. It was illegal for Americans to own gold. It was illegal for Australians to own gold. For Americans, until the first day of 1975, Australians the first day of 76, but the first day of 75, it started falling. Why? There are probably two reasons. One reason, the gold nationalization of 1933, when Roosevelt nationalized gold, he did not confiscate it. When you hear somebody use that word, it's usually some dealer trying to move you into an overpriced collector coin from bullion, because bullion has these minuscule profit margins on it. So I believe it was 73% of all of the gold coins that were in circulation were not turned in to a member branch of the Federal Reserve System, which is what the instruction on Roosevelt's executive order said. And so they remained in private hands, in hiding, but you couldn't do anything with them. You couldn't sell them. And so people sat on those coins for 50 years. So they were passed down from father to son, maybe from father to son to grandson. Who knows? But after sitting on them for 50 years, they were $35 an ounce. Gold had gone from 35 to just under $200 an ounce. And so all that gold that had been hiding in safes and shoe boxes and under the mattress for all those years comes out of hiding and gets sold into the market, and it falls down to 103. Simultaneously, there was a crash, the stock market crash in 74, and then it started to bounce out of it in 75. So the stocks are outperforming gold, but by September of 76, it turned around and went from 103 to 850 on the close, 873 intraday, and coincidentally, the Dow was at 873 points at the same time. So 1 ounce of gold bought the Dow. So that's a picture of the bull market of the 70s. If we zoom up to the 1976 bottom at 103, you can see that gold right at around just below 400. It went past it, but then sort of stalled and went sideways. And that was October and November. And then in early December, it took off again. So during this time period, it worked off some of that overbought condition and then got overbought again. That was this area right here. But once it passed that previous peak, it was just off to the races. And there's only about, I can't remember how many trading days there is. There's holiday, Christmas, it's closed Christmas, New Year's, and so it wasn't very many trading days to get up from this $425 level to $850 on the close, to double in just a few trading days.
Looking forward, Innecco envisions a future where gold tokenization becomes a cornerstone of international commerce. Instead of relying on the volatile swings of fiat or the opacity of central banks, markets could function on transparent, verifiable, gold-backed tokens that move instantly across borders. He foresees this shift unlocking trillions in dormant value, as physical gold stored in vaults becomes part of a liquid, global financial ecosystem. In this new model, gold's importance will extend far beyond being a hedge. It will become the foundation of a more honest, decentralized, and resilient monetary era. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.